Hi, we're going to walk through problem 5-1A, doing FIFO and LIFO. Warner Woods Company uses a perpetual inventory system. It entered into the following purchases and sales transactions for March. And it gives us the dates, it gives us the activity, and the number of units, and what we purchased them for. You'll see it also shows our sales, the units, and what we're selling it for. So we're going to be walking through to determine the cost of goods sold amount and then our ending inventory balance after each transaction. So we're going to use a chart as noted in the book. I know this is a manual process, but it kind of shows you step by step what's happening with keeping track of our costs. So remember, when we're using FIFO, first in, first out, or LIFO, last in, first out, we're keeping track of the different cost layers. This may or may not be the same as the physical flow of product. So on March 1st, we have beginning inventory, 100 units at $50 each. So you see right here, we have 100 units, $50 each. You multiply those two, and we have $5,000 of inventory. On the 5th, we purchased 400 units at $55 each. So we're going to have a column that we're going to keep up with our goods purchased. So 400 times $55 is $22,000. And then we're going to add another costing layer to our inventory balance. So now we have two layers. We have 500 units in total, but 100 is at $50 and 400 is at $55. Now we're going to make a sale on the 9th. We're going to sell 420 units. So the $85 is what we're selling it for. So we're not going to see $85 on this table. This is where we're keeping track of our costs. So using FIFO, we're going to sell the first one in, the first one purchased, and then we're going to move down if we need more units. So first we're going to sell this 100 units that costs $50. Since we sold a total of 420, we need 320 more units, and they're going to come from the $55 layer. So as you can see, we're going to keep track of it in our cost of goods sold column. So here's our 420 units at the two different costs. And then we determine what's left. So we sold all of the $100 layer. We had 400 at $55. We sold 320. So left in inventory, we have $80 at 80 units at $55. On the 18th, we're going to make a purchase, 120 units at $60 each. So we're going to add that purchase. And then we're also going to add it as a costing layer. So we still have our 80 at 55, but in addition, we have 120 at $60. On the 25th, we're going to make an additional purchase. We're going to make a purchase of 200 units at $62. And then we're going to add a third costing layer. So we have 400 units, but at three different costs, equaling $24,000 in total. So you can see I keep writing it if we were doing this on a piece of paper or keeping track of it, each layer, putting it again. I know that takes a little bit of time, but you're less likely to make an error when you're working through these manually. Sometimes if you know that this inventory is here, but you don't rewrite it, sometimes you forget about it. I've also seen students sell the same inventory twice. So it's best to just always keep track of what you have in ending inventory after each transaction. And then finally, on March 29th, we're going to sell 160 units. Again, the $95 is what we're selling it for. So we're not going to see 95 in our chart. We're going to determine the cost for this 160 units. So using FIFO, we're going to sell the oldest or the first one in first. So we're going to sell this 80 at 55. We need 80 more, so that 80 is going to come from that second layer. So that's our total of cost of goods sold. Then we determine what's left in inventory. So all of the $55 product is gone. We had 120. We're going to subtract 80. So we have 40 left at the $60 layer. And then we still have 200 at $62. Now at the end of the month, we're going to determine our total cost of goods sold. So we would add this entire column. So that would be total cost of goods sold for the period. And the cost of our ending inventory is $14,800. For the exam, you're going to need to be able to calculate total cost of goods sold for the month, as well as the cost of ending inventory, both for FIFO and LIFO. So now we're going to go through the same steps for LIFO. That's going to be last in, first out. So we're going to see a difference when we sell product. We will be selling it from the bottom layer or the last one in. So on LIFO, we have the same beginning inventory, 100 units at $50. We made a purchase, 400 units at $55. So we have two costing layers. On the 9th is when we're going to see a difference. We're going to sell 420 units. So again, we're going to be selling from the bottom layer. So we're going to sell all 400 of the $55 layer. And since we need 20 more, we're going to go and sell 20 of the $50. Then we determine what's left in inventory. So all of the 400 at 55 is gone. So we had 100, we sold 20. So we have 80 left, but it's going to be at this original first cost, $50. Then we have two purchases on the 18th and the 25th. These are going to be the same as with FIFO. We're just going to add them to the bottom of our costing layers. And then finally on the 29th, we're going to sell 160 units. With LIFO, we're going to sell them all from the bottom layer since there's adequate inventory. So we're going to sell 160 units at $62. And then left in inventory, we still have the first two layers, 80 at 50 and 120 at 60. We had 200 minus 160, so we have 40 left at $62. So our total ending inventory is $13,680.